Welcome to our third video presentation on Diva Shoes. In our previous Diva Shoes presentation, we talked about Diva Shoes hedging its exchange rate exposure using options contracts. In this presentation, we consider Diva Shoes hedging possibilities using forward contracts. To recap, Diva Shoes faces the following problem. Diva Shoes sells shoes priced in Japanese yen. The actual and projected sales is going to be 3.6 billion yen. The projected exchange rate is 90 yen equals $1. But we're going to consider a scenario in which the exchange rate appreciates in yen to 70 yen equals $1, and an alternative scenario in which the yen depreciates to 110 yen equals $1. Suppose we enter into forward contracts to buy US dollars for all 3.6 billion yen of sales. Now, we don't necessarily know for certain that Diva Shoes is going to have 3.6 billion yen of sales, but we're going to ignore that volume risk just for the moment to illustrate the difference in outcomes from Diva Shoes being hedged versus unhedged, and to contrast the situation of options contracts and futures contracts. We're going to consider the cost of the hedge, which in this instance will be zero for reasons I'll explain in a moment, and the payer from the hedge if the option finishes in the money. That information, of course, is redundant in this situation because we don't have options contracts now. We have forward contracts. And the difference between the forward contract and the options contract is that Diva Shoes has to go ahead with the deal. Diva Shoes is going to exchange 3.6 billion yen for US dollars under this forward contract, regardless of what the exchange rate is at the end of a 6-month period. The cost of the hedge is going to be zero, and that's the case for forward contracts more often than not, because when you have an option contract, that's only going to be beneficial to one side of the deal. The person buying an option always has the option to exercise the option, whereas the person selling the option might be forced to do an adverse exchange of a commodity or a currency at the end of the option period, the expiration date, but there's only upside for the buyer of the option. So the compensation for bearing risk for the seller of the option is an upfront payment. So in this particular application, Diva Shoes had to buy 40 million options for a price of 2.48 yen per contract. But in the situation of forward contracts, Diva Shoes is not going to pay anything upfront because there is a symmetrical distribution of outcomes for the buyer and the seller of the forward contract. So let's contrast the financial outcome for Diva Shoes from being hedged or unhedged under different exchange rates. The financial statement information on the left-hand side of this table is identical to what you saw earlier for options. In the unhedged situation, if the exchange rate is 90 yen at the end and on average over the 6-month period, sales of 3.6 billion yen converts to 40 million US dollars. If we have an appreciation of the yen to 70 yen equals $1, net sales in US dollars are going to be $51.4 million. And if we have a depreciation of the yen, sales are going to fall to 32.7 million US dollars. That fluctuation in sales versus expectation is going to flow through to an operating profit excluding hedging, which could range anywhere from $0.2 million to $7.5 million or up to $18.9 million. So you've got a large fluctuation in earnings as a result of this fairly modest fluctuation in revenue. And that's because the costs are all denominated in US dollars. The reason Diva Shoes might care about that fluctuation in profits is because of the interest expense. To finance its operations, Diva Shoes has borrowed money and is projecting to have to pay $2 million of interest to its lenders. That's a fixed cost. And at that low earnings scenario in which the yen is worth 110 equals $1, the pre-tax income would fall to minus $1.8 million, and the after-tax income would fall to minus $1.1 million under our very crude assumption that after-tax income is just 60% of pre-tax income at a constant tax rate of 40%. So this possibility of becoming financially distressed could have a material, long-term, asymmetric consequence for Diva Shoes, and that meets our criteria for considering whether you want to be hedged. Now, not everyone hedges their exposure to exchange rates, but Diva Shoes might think along those lines because it could face this asymmetric payoff if the company becomes financially distressed, and if it can't get an equity injection, the assets of the company could transfer to the lenders in bankruptcy, and Diva Shoes wouldn't be in a position of being able to recover when the exchange rate reverts to a more normal level. So the payoffs are truncated. The lender could be made whole or recover a substantial amount of what it lent to Diva Shoes, but the equity holders would be out of the game. So let's consider the hedged position. If Diva Shoes enters into forward contracts, under this particular scenario in which we've removed the volume risk, what you're going to see is that there is no fluctuation in the operating profit, pre-tax income or net income, regardless of whether the exchange rate was 70 yen or 110 yen or any other level. And that's because by entering into a forward contract, Diva Shoes has essentially locked in the exchange rate of 90 yen equals $1 for all of its sales. Let's work through the income statement. In the upper section, we've got the same information that you can see on the left-hand side. Fluctuations in operating profit excluding hedging, contingent upon exchange rate movements, which could be $0.2 million, $7.5 million, or $18.9 million. But those fluctuations in operating profit excluding hedging are perfectly offset by the hedging payoff depending upon the exchange rate movement. If the exchange rate appreciates to 70 yen equals $1, the hedging payoff to Diva Shoes is minus $11.4 million. And that's computed as the $90, so the $70 spot price minus the 70 yen spot price minus the 90 yen exercise price divided by the 70 yen spot price times 40 million contracts. So an increase in sales of $11.4 million by the exchange rate appreciating is perfectly offset by a reduction in earnings because of that negative hedge payoff. And we have net income of $3.3 million. On the flip side, if the yen depreciated, we would have a reduction in earnings of $37.3 million from lower sales when we convert to US dollars, but we would have a positive payoff from the hedge contract of $7.3 million. Again, we've simply locked in the exchange rate of 90 yen equals $1. Now, in reality, you can't just lock in the exchange rate. The reason you can't just lock it in is because you don't know how many contracts to write. You can estimate we have to write 40 million contracts, but the yen sales might be different to 3.6 billion yen. We've also assuming perfect foresight over the costs and cost of goods sold and perfect foresight over the selling, general and administrative expenses. Those things might not hold either. And that's why we've got this sort of fiction that net income is going to be constant regardless of what the exchange rate happens to be. There will be economic circumstances which are correlated with those exchange rates which would affect the outcomes in reality. But this is a starting point. So let's contrast the situation of hedging with forward contracts and hedging with options. In the table you see here for forward contracts, it's quite clear that Diva Shoes would prefer a constant net income of $3.3 million versus a substantial chance of losing $1.1 million. But maybe Diva Shoes doesn't really care that much about losing $1.1 million. Maybe Diva Shoes has an owner which can provide new equity capital should it lose $1.1 million in a given year. But suppose hedging is important, Diva Shoes would prefer forward contracts over an unhedged position, but it wouldn't necessarily prefer forward contracts over hedging with options. Let's contrast the payoffs. In this next slide, I have replicated the outcome from our options analysis, which we considered in an earlier presentation. And in the subsequent slide, I contrast the position between hedging with forward contracts and hedging with options. So let's do a comparison. Under options, we said that the operating profit, including hedging activities, could range from 6.4 million to 17.8 million. That flows through to pre-tax income of 4.4 to 15.8 million and 2.6 to 9.5 million on an after-tax basis. If we consider the forward contracts, we have a locked-in profit, ignoring all of those other uncertainties that we talked about, of $7.5 million before interest, $5.5 million after interest, and $3.3 million after tax. So in the situation in which the yen depreciates, Diva Shoes would be better off with the forward contract. $3.3 million of net income beats $2.6 million. But in the situation in which the yen appreciates, Diva Shoes would have been better off with the option contract, because 9.5 million beats 3.3 million of net income. So it's not obvious as the CFO for Diva Shoes whether it's better to lock in that net income stream of $3.3 million or to have variation in the possible net income stream of 2.6 to 9.5 million, because there could be more upside potential for Diva Shoes depending upon its view as to how exchange rates might move. Hedging with options, as a general statement, is going to be the riskier but higher payoff position for the company. Hedging with forward contracts is going to be the lower risk but on average lower payoff position. And that's because you are giving away the upside when you hedge with forward contracts, because you have to complete the exchange of currencies at the expiration of the contract, whereas with options, you have some upside potential. Of course, with options, you have to pay the $1.1 million upfront, and that means that in the situation in which you don't exercise, in the situation in which the yen depreciates, you're worse off with the option contract compared to the forward contract. So finally, you can compare the outcomes from being hedged with options, being unhedged or hedged with forwards on a pre-tax basis and after-tax basis, and on a pre-interest basis, as you can see in the table on the screen. The last thing to consider with regard to Diva Shoes is that you wouldn't necessarily have a hedging profile in which you just look at earnings over the entire 6-month period. Most businesses, including a retail business or an airline like JetBlue, will have a hedging profile which is tapered. What that means is that you're going to hedge more of your risk exposure in the short term and less of your risk exposure in the long term. If you look back at your JetBlue case, there was a higher proportion of costs which were hedged 1 quarter ahead, and then a relatively lower proportion of costs which were hedged 2 quarters, 3 quarters, and 4 quarters ahead. And the reason for that is because over a period of time, if your costs are increasing, you have more opportunity to restructure your business to deal with that increase in costs. For Diva Shoes, if the exchange rate is moving in an adverse direction for Diva Shoes over a longer period of time has more relative ability to alter its business to account for that variation in the exchange rate. Now, Diva Shoes doesn't have quite the same flexibility that JetBlue would have, because Diva Shoes is competing in a local market in which it's competing against other retailers selling in yen. So just because the exchange rate moves in an adverse direction for Diva Shoes that has cost in US dollars doesn't necessarily mean that Diva Shoes could increase the price of its shoes in yen. Other retailers in Japan that have a Japanese cost base wouldn't increase their prices. But could Diva Shoes cut its costs? Could it say to its employees, or could it say to its landlord, or say to its suppliers, can we reduce our input costs because our revenue in US dollars is coming down? There could be a renegotiation that flows from this potential risk of the company becoming financially distressed. That wouldn't be easy, but it is a possibility. Again, whether you hedge or not has to be done on a case-by-case basis, and it isn't necessarily true that every company should hedge. Companies disagree. But remember our key criteria. Is there a material, long-term, and asymmetric impact of an adverse movement in a commodity or an exchange rate or some other underlying risk? And if there is a material, adverse, and asymmetric impact of that underlying asset moving in a particular direction, that is possibly the justification for a hedge. That completes our video presentations on JetBlue and Diva Shoes. I will be posting an online quiz for you to test your knowledge of these concepts and solutions. I'll also be posting contact details for help sessions in which we can have a discussion about hedging and work our way through some of these computations. Please, in advance of attempting that quiz and in advance of help sessions, try to replicate the computations which we've done in these two presentations. Take the spreadsheets that you have available to you, try to replicate the outcomes from a blank spreadsheet. It's only by computing the analysis that you'll fully understand the analysis. And I will talk to you soon.